Hey everyone, welcome to this video. I'm Daniel Rondberg, and in this video I'm going to break down what are index annuities, and I want to tell you a story about something called the goose and the golden egg. People come to my office all the time and they're baffled by index annuities. Let me back up and just tell you what index annuity is and what it does and what it doesn't do. An index annuity is basically an agreement between you and an insurance company. You can put money into this index annuity. It's going to have a term that it comes with, meaning a length of time you have to keep it with the company, otherwise there's a penalty. And they're going to be able to keep your principal safe. They're going to be able to protect your principal from going down, but they will give you index credits based on participation from an index that's underlying within the annuity. So usually the choices are S&P 500, Dow Jones, Russell 2000, the Barclays has a whole series of different indexes, Credit Suisse has a whole bucket of different indexes, and there's a bunch of different proprietary ones out there that are absolutely incredible, and then there's some that I don't use. Basically what it allows you to do is allows you to get some of the upside potential in exchange for protecting your principal and not having the downside risk. And the reason why this is important for some people is as you enter retirement and you're getting closer to needing your money and your risk capacity isn't as great as it was when you were in your building earning years, this is a really valuable tool because it can keep your principal safe. Now, let me just tell you right there, that's what it does. It can perform, and I've had them perform well. I've had them perform not as well. That's why you buy an annuity, to keep the principal safe. It can produce index credits based on the upside potential. I think they are way over illustrated in a lot of cases. And I think that's why they get a bad reputation, because there's agents that will pump up their performance to like double-digit numbers. I just saw one recently. I was speechless when I saw it. I'm like, if this was real, everybody would buy this. But it's not going to earn 14% year over year over year. I couldn't even believe the company was illustrating. It was absolutely just ridiculous to me. I tell my clients, look, it'll probably do 3 to 4%. That's it. I mean, it's not like it's going to be something where you're going to get 7% a year in it or higher. It's not. It's capped on the upside in exchange for protecting your principal. Remember, it's about protecting your principal. But it does have upside potential, and it can make money based on that underlying index through those index credits in those segments. So typically, you put your money in on an anniversary date or a buy date, and then a year later, they're going to watch the performance of the index. They're going to credit a percentage of change up to your cap or your participation rate, or above your spread, and then they're going to credit that to your account on your anniversary date a year later, and then you get a chance to reallocate it and you get to go again. If the market or the underlying index were to go down during that time, your principal's protected. You're not going to lose any money. So it's got that nice trade-off for you. I mentioned a cap, a participation rate, a spread. Some index annuities will say, hey, we're going to give you a 4% cap on the S&P 500 and what they call an annual point-to-point. 1 year option on the S&P 500, you can make up to 4%, you're not going to lose any money. Okay, that's one option. Now, some of the caps are much higher now because interest rates are going up. Just giving you an example, the cap could be 7%. It also could be a participation rate. They'll say, hey, we'll give you a 70% participation rate on whatever the S&P 500 does. So if the S&P 500 goes up 10, you would get 70% of that. You'd get about 7%. And that's what a participation rate is. And then there's a spread. Maybe they say, we're going to keep the first 5%. You get everything above 5%. So if the S&P 500 goes up 15, they keep 5, you would get 10. Just an example, right? Now again, I'm using bigger numbers there, but it's probably going to be over the long course of things, smaller numbers, just to manage expectations and make sure everybody's happy with index annuities and not disappointed because they're seeing 14% returns on illustrations. Crazy. It's too much. People always ask me, they go, well, how are they doing that? I don't get it. How are they able to keep your money safe, but then be able to let you participate in upside potential? And this is where I tell people the story of the goose and the golden egg. Now, I don't really tell people this story when I'm sitting with them because I just think it's weird to tell somebody a nursery rhyme. It's not even a nursery rhyme, but like a little fable to explain how this works. But essentially, everybody's familiar with the goose and the golden egg, right? There's this goose, it lays golden eggs, and as long as the goose is protected, it's going to continue to produce golden eggs. That's kind of how you can explain indexing. Think of the goose as the annuity, and it's going to keep your principal safe. And as long as it stays there in the annuity, the principal will stay safe. Now, every year during that segment for your indexing, that year time that they look at the market, how are they able to give you upside potential, but then if the market goes down, protect you? Well, what they're doing is they're buying an option. And if the option goes up, they're going to exercise it, and you're going to participate in up to that cap, or up to your participation rate, or above your spread. If the market goes down, or the index goes down, they're just going to toss it out. And the way they do that is basically they're only on the hook for, let's say, 4%. Say you put $100,000 with the annuity. It's not like they're taking the $100,000 and investing it and hoping it works out. That would never work. What they're doing is they're taking the $100,000, they're putting it into an account known as their general account. This is very, very safe. They're going to keep it in the sidelines. They're going to take 4% interest that it can earn in the time it's sitting there, and that's what they're going to use to buy your option. Now, if it goes up, that's how they have the money to do that. They're going to credit it to the account. Your principal will now grow. They'll put that into the general account. It'll be locked in. So when you make an interest credit, it's not going to fluctuate and go back down if the index goes down the next year. Say you make that 4% the first year on your 100,000, now you have 104,000. They're going to produce 4% on that to go buy another option and do it again the next year. That's how it works. So it's basically like there's a goose and then there's a golden egg that's going to be able to produce that option budget to be able to allow you to participate in the index, but still allow you to keep that principal protection on your annuity. Now, a couple other words that I want to just throw out there, or a couple other ideas I want to share on annuities. That's how they work with the index. But there's also riders you can purchase for specific intentions that you want. The specific intentions are guaranteed lifetime income, long-term care, or what they would call enhanced benefits. Some annuities have true long-term care riders you can add, which means that if you have 100,000, they're going to make it look like you have maybe 200,000 or 300,000 for long-term care. That's a special type of annuity that's available. Like it has like an annuity long-term care hybrid. You can just buy a rider to do that. It doesn't even matter about the indexing. There's more focus on benefits. You could buy an income rider. Again, it's not real money. It's money that would kick in to basically build up what's called a benefit base, kind of like how Social Security works, where you would defer the money, you would grow the money in this benefit base over a period of time, and then that number would be what they use to figure out the lifetime income that they're going to pay you every single month for as long as you live. Even if you spend down all the principal in the annuity, they're still going to pay you that income payment as long as you're using it through the rider properly. It's like Social Security, because let's say you choose a rider where you pay a 1% fee, but you get a 7% roll-up. A roll-up is the number they're going to increase your money by every single year to build up that base for then you to only take income on. Like I said before, if you only expect 3 to 4% from your annuity on the indexing side, you can buy that rider that's going to give you that 7% increase every year, and that's going to give you a much bigger benefit base, and that's going to give you a much bigger number that they're going to calculate your lifetime income off of for the rest of your life. So it's like a benefit that you can't withdraw that money or take it out at the end of your surrender charge term. It stays there, but it produces that lifetime income. So the bigger you get it, the more your income will be. But it's not like a growth rate. People get confused all the time, and that's a huge issue with index annuities and income riders. People say, oh, mine earns 7%. No, it doesn't. It has a 7% roll-up. They think they can take it off the top like interest. You know, like, oh, my 100,000 is going to earn 7%. I can always take 7% and never run out of principal. That is not how that works. And there's a lot of people that think that's how their annuity works. But it'll produce a lifetime income stream that you can take out for as long as you live, and you can even make it set up joint for you and your spouse. Now, there's a third option, which is for death. And this is a great option for people who can't qualify for life insurance, but still want to have that benefit for their family or their loved ones. You can buy a death benefit roll-up, where basically you can say, I want my annuity to grow by 8 or 9% every year, but it's only going to pay out upon my passing. And oftentimes those can be a lump sum. You can structure them as a 5-pay or even a 10-pay, meaning that after you pass, it'll distribute the money for 5 years to beneficiaries or 10 years to beneficiaries. Or they might have an option for a lump sum, and they might be able to forfeit that interest just to take more money out up front. There's all kinds of ways you can structure it. But again, that's what index annuities allow you to do. They allow you to keep that principal safe, like that goose, and then have these golden eggs that'll be able to provide either index credits or benefits for you to take over the course of your life. If you like this video, please think about giving it a thumbs up and hitting the like button. Please also comment down below if you have questions on anything I discussed, or you just want to get into a great conversation. Click the link. I'm happy to talk to you. Please leave your comments, and I reply to all of those, and I'll see you in the next video.